Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did.
Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning?
Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome.
You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
I'm Jeffrey Shank, and this is Talk Money. Welcome to the show. A little bit about me. I am a chartered financial consultant. The name of my firm is Andover Advisory Group, a registered investment advisor. And for better than 25 years, I have provided effective financial advice to individuals and small businesses. And my mission here on Talk Money is really simple. It's to improve your money IQ. So welcome to the show. Thank you for joining me. Good morning, Lou. How are you this morning?
Good morning. I'm doing okay.
Hey, we're going to talk about second generation inherited IRAs.
Second generation
inherited IRAs. Yeah. So the rules for how you distribute money that you inherit through a retirement account,
right,
have been changing as of late, and it's very confusing.
It's very constantly changing.
Yeah. And so IRAs have been around since the 70s, but it is now becoming more common that people who have inherited IRAs from somebody are now passing on and leaving those very same IRA accounts, because they haven't cleaned them out totally,
right,
to their beneficiaries. And so that's what we call a second generation inherited IRA.
All right.
So it refers to an account inherited by a beneficiary who themselves inherited the IRA from the original owner. The accounts are subject to complex rules that depend on when the original. Now, gotta pay attention, Lo.
Okay.
Okay. It depends on when the original account owner died and the beneficiary's classification. The Secure Act, which was effective in January 1st of 2020, significantly changed these rules. So now we're operating with two separate sets of rules.
Yep.
And basically replaced the previous stretch IRA provisions, right? The stretch IRA was the circumstance where you would inherit the IRA, and if you were eligible to do so, you would stretch out the distributions
right
from that IRA account, minimizing the overall tax impact if you didn't need or want to pull all the money out. That's what the stretch IRA is all about. So understanding distinctions is critical for tax planning and compliance. Beneficiaries have to consider whether the original owner died before or after the required beginning date, RBD for short.
Okay.
The required beginning date is the date that you as the IRA owner have to start making distributions from your retirement accounts.
Okay.
Required minimum distributions, RMD, right?
The original owner.
The original owner.
Yeah. Okay.
Right. And so that used to be age 70 and a half.
Mhm.
And it was that way for years. Then they changed it to 72
Mhm.
and then 73. So
Right.
depending on when you were born determines whether or not you had reached that required beginning date. And so if you've inherited this IRA, you need to understand if that person had reached their required beginning date, because that determines how you can take distributions from your inherited IRA. And of course, it depends on whether or not the person died before or after the Secure Act, which December 31st, 2019 was the end of the old rules, and January 1st, 2020, beginning of the new rules.
Wow.
Got
Okay.
it?
Yep.
You confused yet?
Were they taking their
Look-
RMDs, and did they die before the Secure Act?
So far, you get it.
Yep.
Yes.
So far. There's
So
more?
far. Oh, yeah.
Okay.
Now you have to determine whether or not you qualify as an eligible designated beneficiary, EDB.
Okay.
Okay. So these are all factors that determine whether distributions can be stretched over the life expectancy of the beneficiary, or you have to follow the 5 or 10-year rule. So we're going to take a look at these rules, compare the pre-2020 and post-2019 frameworks,
Wait,
and then
5-year
provide
rule? There's a 5-year
There's a
rule?
5-year rule.
Oh,
Yeah.
I
There's
knew
a
about the
5-year.
10-year rule.
Yeah. Well, there's a 5-year rule, Lou.
Oh, God.
Okay. So let's take a look at it, right? So before January 1st, 2020, beneficiaries of inherited IRAs could use the stretch IRA strategy, taking RMDs based on their own life expectancy. That allowed tax-deferred growth over decades.
Okay.
Alternatively, if the original owner died before their required beginning date, beneficiaries could elect the 5-year rule, requiring full distribution by December 31st of the 5th year following death. Spouses had additional flexibility, including rolling the account into their own IRA. And so these options provided significant planning opportunities for minimizing taxes and preserving assets. So that's the old rule, pre-2020. The post-2019 rules, effective January 1st, 2020 and beyond, the Secure Act eliminated the stretch IRA option for most non-spouse beneficiaries
Mhm.
and introduced a new 10-year rule. Under this rule, the entire inherited IRA has to be distributed by December 31st of the 10th year following the original owner's death.
Right.
If the owner had begun RMDs before death, annual RMDs are required even during the 10-year period, right? So the 10-year rule says that you have to have the account cleaned out within 10 years.
Yep.
Right. By the 10th year. And if the required, if required minimum distributions hadn't begun for the original owner, then you don't have to take anything. You could take as much as you want or nothing.
Right.
Over that 10-year period. But at the end of 10 years, probably wouldn't want to do that. The money, all the entire balance would have
Right.
to be distributed at that point in time. However, if required minimum distributions began before the original owner died, then you would be required to take at least a minimum distribution each and every year.
Fair
Okay.
enough. Yep.
Yeah. Now, eligible designated beneficiaries, which we alluded to earlier, EDBs, are spouses, minor children, doesn't have to be your children, disabled individuals, chronically ill individuals, and those that are not more than 10 years younger than the decedent. So original owner dies, leaves the money to a spouse, minor child, disabled individual, chronically ill individual, or someone who is not more than 10 years younger than the decedent can still use the life expectancy-based distribution option.
Okay.
So this change obviously accelerated taxation for most heirs and does require careful planning to avoid penalties. Just to compare the 5-year rule with the 10-year rule, The 5-year rule requires full distribution by the end of the 5th year after the original owner's death, offering no annual RMDs but accelerating taxation. The 10-year rule provides a longer window, but may again require RMDs if the decedent had begun distributions from their account on a mandatory basis. In other words, they reach the required beginning date. Both rules do eliminate the lifetime stretch option for most beneficiaries, but the 10-year rule offers a little bit more flexibility than the old 5-year rule, right, which would come into play if you weren't that eligible beneficiary. There is still a 5-year rule if the beneficiary is not a person. So if you leave, if your beneficiary goes to if your beneficiary is your estate or the retirement account is paid to your estate or to a trust, then there is no 10-year rule.
Right.
The 10-year rule is only available for a person.
Yeah.
Right. The 5-year rule applies to anything other than a person, and a beneficiary other than a person. With me so far?
I'm with you so far, I think.
So a little closer look at the 10-year rule. Okay, it requires that the entire balance of the inherited IRA be distributed by the end of the 10th year following the original owner's death. If the decedent had started required minimum distributions, beneficiaries have to continue annual RMDs during the 10-year period, calculated using the decedent's life expectancy, not yours.
Right.
So the older you are, the
higher the percentage of
the
RMDs.
higher the percentage of the account that has to be distributed. Correct. Yeah. And by the way, how it is calculated, you take the ending balance from the prior year. So you have to take a distribution this year. You look at the December 31st value of that account from the prior year, and then you use a life expectancy table or some other life expectancy table in this particular case, and that gives you your divisor.
Yep.
And as that divisor becomes smaller because your life expectancy is shorter as you get older, that increases, as you said, the percentage that has to come out every year. Okay. If the decedent had started RMDs, beneficiaries must continue RMDs during the 10-year period, calculating using. Oh, I already said that. I'm sorry. Yep. Mm-hmm. No contributions can be made to inherited IRAs, and failure to comply results in significant penalties. Planning strategies include spreading withdrawals evenly across the 10-year period to manage tax brackets or deferring distributions until later years if allowed. And the rule applies broadly to non-eligible designated beneficiaries and successor beneficiaries, making it essential to understand timelines and exceptions. So who qualifies and what are their choices? So to know who is not an eligible designated beneficiary, you really need to know who is an eligible designated beneficiary.
Yeah, let's go there.
Right? So an eligible designated beneficiary includes a surviving spouse, minor children of the account owner, disabled individuals, chronically ill individuals, and persons not more than 10 years younger than the decedent.
Minor children. So if your children are over 18, they're not eligible.
This is correct. Yes. Interesting, huh?
Yeah.
Yeah. Though these beneficiaries can continue to use the life expectancy-based distributions, preserving some tax deferral. Spouses have additional options, such as rolling the account into their own IRA. And this is important to your minor child, your recognition of this age of majority, right?
Yeah.
Oh, and by the way, it's age of majority. It's 18. I don't know if the rule says age 18. It might depend on the age of majority in the state where you reside. I don't know the answer to that question. And I think I said earlier that that this applies to minor children, regardless whether or not they're your children. I think I misspoke there. I think it has to be your child, to be considered an eligible beneficiary. So here's the here's one caveat: minor children lose their eligibility upon reaching age of majority, triggering then the 10-year rule.
So if your beneficiary is a 16-year-old, in 2 years they lose their eligibility,
Correct.
or whatever the age
3
majority
years,
is.
whatever the age of majority is. Yeah. Okay. So understanding these classifications crucial for estate planning, ensuring compliance with IRS regulations. And
They want their tax money.
yes, they do. And so when an IRA has multiple beneficiaries, though, it gets a little more complex. So the separate inherited IRA accounts have to be established by December 31st of the year following the original owner's death to allow each beneficiary to apply their own distribution schedule, right?
Yep.
So if accounts are not separated, distributions are based on the oldest beneficiary's life expectancy. Under the pre-2020 rules for the 10-year rule, under post-2019 rules. So beneficiary's life expectancy for pre-2020, and then 10-year rule for post-2019 rules, unless you're an eligible designated beneficiary. So what's the takeaway there? Best thing to do, if you're inheriting an IRA account and there are other beneficiaries, you want to make sure that you set up separate accounts by December 31st of the year following the year the person died. Otherwise, what ends up happening is they take the oldest beneficiary and apply whatever the rule is for that.
Worst case scenario.
Oh yeah. So you want to segregate those. You want to segregate those accounts as soon as you can. When you inherit that particular IRA account. And just to give you some examples here, spouse inherits an IRA in 2021 and rolls it into their own account. They can roll it into their own account, continuing RMDs based on their age.
Right.
And I just want to say something about that. Although it's possible for a spouse to roll over, and this was true under the new rules and the old rules. Although it's possible for a spouse to roll it into their own name, there could be a reason not to do that and to choose to treat the account as an inherited IRA, not your own IRA account. And that reason is that once the money is in your name, now you are subject to any restrictions for withdrawals, including the age 59 and a half rule.
Oh, okay.
Right.
Yep.
So you lost your husband. You're 45 years old.
Yep.
You need money to pay the expenses, maybe put somebody through college. Right.
Yep.
And you've got this chunk of money that's sitting in an IRA account, but you rolled it into your name. If you take the money out, suddenly you're going to be subject to income taxes. Now, you'll always be subject to income taxes, but the premature withdrawal penalty would apply. So if you left it in the inherited IRA, you would actually have access to that money without penalty. And you can always and I'm pretty sure that this is true, that there's always the option later on to roll it into your name. So once you turn 59 and a half or get close to that point, rolling it over into your name might be a better solution, right?
Don't try this at home.
Don't try this. Yeah, exactly. Yeah. Again, it is so complex, and anytime anybody asked me about this, here's the situation I have to do, and I always have to go back and look and see, okay, how does this going to work pre-2020, post-2020? RMD started, when did they? Yeah. So it's very complex. And I actually found this really neat tool. It's a graphic decision tree.
Oh, wow.
It's all on one
Okay.
page, and it says, are you an eligible designated beneficiary? Yes or no, and it takes you to the right. It
Nice.
was very, very helpful. Very helpful. I'm a visual person anyway. I think that's the reason why. All right, so that's if a spouse inherits, right? So example 2, a minor child inherits an IRA in 2022, stretches distributions until age 18, then becomes subject to the 10-year rule. Example number 3, a non-eligible beneficiary inherits an IRA in 2023, has to distribute the entire balance by 2033. And remember, you may not have to take any money during that 10-year period if you don't want to, depending on whether or not the original owner was required to start taking minimum distributions. If they were, then you have to continue taking those minimum distributions for that 10-year period. You can take more, but you can't take less, right? And then example number 4, we still got the pre-2020 rules. A non-spouse beneficiary could stretch distributions over their life expectancy, significantly reducing annual tax burdens compared to the 10-year rule. So if you inherited that IRA prior to, or if the person died prior to 2020, and as time goes on, there'd be less and less circumstances where that would be the case.
But they're grandfathered.
But they're grandfathered in if you right, exactly, and you can still use the stretch rule. So if you didn't know what you should do, or somebody was telling you you had to take more or less, or that suddenly you are subject to the 10-year rule, if the person you inherited the IRA from passed away before December 31st, or by December 31st, 2019, then you still have the option to use the old rules if you're an eligible beneficiary. So.
Yeah.
How's that, clear?
Yeah. Clear as any government policy.
I'd say if you have any, and there, and let me just say, there are so many tools out there that you can use to you plug in dates of birth, dates of death, and they give you they give you the answer. You tell them how much the account was worth, and I've used them quite a bit. And there's a lot of information out there, a lot of articles on this. The second generation IRA is probably the one that is the most difficult to can imagine to understand, simply because you have depending on who you are, whether or not and when that person died determines whether or not you have to continue to go by the old rules or the new rules. And so don't just assume that this tool that you're plugging the numbers into is giving you the right information, because it's very possible it could be wrong. Right. So
if you're second generation inherited IRA, second generation,
depends on when that person died.
Do all these rules apply to the person you inherited it from?
Right. So if that person died post January 1st, 2020 or beyond, you go by the most recent owner's date of death. Yes. Yeah. Right. So
a good subject to the free consultation.
If you've inherited an IRA, you're not sure what to do. Definitely give us a call. If you want to get in touch with me after the show, feel free to use the toll-free number 877-475-2062. You can send me an email. It's jeff@talkmoneyradio.com. All right, Lou, we're going to take a quick break, and when we come back, we've got the Talk Money or Ask Jeff question of the week. So please stay tuned.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005.
This is Talk Money. I'm Jeffrey Shank, and this is this week's Ask Jeff question.
I love the new music. I love it.
Do you like it? That's
I'm ready
good.
to go. Yeah.
Oh, so here's the question, Lou. I inherited an IRA from my mom.
How topical.
It is. My sister and I were the primary beneficiaries. My sister is in a much lower tax bracket, and we want the whole account paid to her.
Okay.
The bank says they have to pay it to both of us in equal shares. Is this true? Can I say I don't want my share? You think this is a good idea? All right. So it gets a little complex.
Yeah.
All right. So the bank is telling you the truth in that if the beneficiaries are you and your sister, primary, in equal shares, they really have no choice.
Right.
But to pay it to both of you, unless you were to execute what's known as a disclaimer. Now, this is a legal document. It's where you say, I don't want this.
Yep.
Can't be any strings attached. So it has to say you're giving up the asset, your right, your claim to this inheritance, right? It has to be done within a certain time period. I don't recommend that you try to do this yourself. You may try to create a document using artificial intelligence. That might work, but you might want to consult with an attorney just to make sure you're doing it right. But if you do that and deliver that disclaimer, and you don't have to disinherit yourself from the entire estate. You can pick specific assets to disclaim.
Okay. Yeah.
Right. So you don't have to say, I don't want anything. You just say, hey, I don't want this. And you deliver that document within the requisite time frame, then they will have to. They would be compelled to pay it to or use whatever the rule is. So if the rule there is that because of your disclaimer, there was only one beneficiary, well, then they're going to pay it to that,
right,
to that beneficiary. Be careful because it depends on the rules of the plan.
Right.
So because you don't want it going to someone other than, in this case, your sister, right?
Mm-hmm. Yeah.
Now the question is, this a good idea? Well, if you don't need the money, and your sister is in a much lower tax bracket than you,
yep,
then yeah, it could make a lot of sense for you to just have it all paid to your sister, and despite the disclaimer saying there's no there are no strings attached, nothing prevents your sister from taking money and giving it to you for whatever reason, right? As long as she's doing it on her own, without any pressure or coercion, right? So I think it's a good idea. It's a good tax planning tool potentially, and maybe you don't need the money and your sister does, and she's in a lower tax bracket, so it makes sense for her to do that. Oh, and by the way, if this is part of an estate, there wouldn't be anything wrong with having your sister disclaim a different asset that maybe doesn't have the kind of tax consequences as the IRA account. So now you can sit down as a family and say, hey, here's how we're going to approach this, and work with the personal representative, which might be one of the family members of the estate, and come up with a good distribution plan that maximizes the overall tax consequences.
Trade off inheritances.
Yeah. So these are the kinds of questions we get on a daily basis. And so if you have a question that you'd like us to answer, just let us know. Send me an email, jeff@talkmoneyradio.com. You can send a direct message right on our Facebook page. It's facebook.com/talkmoneyradio. And or you can just use the telephone number. It's 877-475-2602. And that wraps that segment up. Remember, when we get together, before we get together again, please remember, good sound advice is much better than advice that just sounds good.
Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did.
Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome.
You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
I'm Jeffrey Shank, and this is Talk Money. Welcome to the show. For those of you who might be joining us for the first time, a little bit about me. I am a chartered financial consultant. The name of my firm is Andover Advisory Group, a registered investment advisor. And for better than 25 years, I have provided effective financial advice to individuals and small businesses. My mission here on Talk Money, very simple, to improve your money IQ. Good morning, Lou. How are you this morning?
Doing very well.
How are we doing? We're doing good, right?
Yep, we're doing good.
All right.
It's warm today,
That's nice.
relatively speaking.
And the looks like all the snow is gone.
Yep.
Not going to be a white Christmas. Looks like, right? Won't be a
Yeah.
white Christmas. Are you disappointed?
No, not in the least.
Hey, so we're going to talk about the backdoor Roth IRA, Lou.
All right.
Yeah, sounds sinister, doesn't it? Backdoor. Sounds like it might be illegal.
Not a word I'd use, but okay, yeah.
Oh, illegal at the very least. Illegitimate, maybe. I don't know. Coming in the back door.
Yeah, but-
It's like, it's like you're hiding something.
Yep.
Right? No, it's not. It's a legitimate financial planning strategy, and I wanted to go over it because, and we'll get into this a little bit later, may not be around forever. So we'll
like
just
all of these programs, right?
they probably call it a loophole. So a backdoor Roth IRA is not a separate type of retirement account. Rather, it's a legal strategy that allows high-income earners to access the benefits of a Roth IRA despite income restrictions. So normally, individuals with incomes above certain thresholds can't contribute directly to a Roth IRA. For 2025, single filers earning more than $165,000 and married couples earning more than $246,000 are ineligible to make a direct Roth contribution. So the backdoor Roth IRA circumvents this limitation through a two-step process. First, you make a non-deductible contribution to a traditional IRA. And second, convert that traditional IRA to a Roth. You convert it. Mm-hmm. So as of now, anyway, you can convert 100% of your assets in a traditional IRA to a Roth IRA with no income restriction. Now, the caveat there is that whatever money that hasn't been taxed in your traditional IRA, it has to be it's going to be taxed when you pull it out and do the conversion. Taxable. So you have to So you have to pay the taxes on whatever in your Roth IRA has not yet been taxed, right? So keep that in mind. That's very, very, very important. This approach leverages the fact that while Roth IRA contributions have income limits, Roth conversions do not. Once funds are in the Roth IRA, they grow tax-free, qualified withdrawals in retirement, and are also tax-free. Mm-hmm. Additionally, Roth IRAs do not require minimum distributions during the account holder's lifetime, offering flexibility and estate planning advantages. The estate planning advantage there, by the way, is that it goes to your beneficiaries without any income tax. So as long as the plan is qualified, when your heirs inherit the account, although they do have to make minimum distributions, right? Those distributions are still tax free. Okay. So particularly appealing for individuals who expect to be in a higher tax bracket during retirement or who want to maximize tax-free growth over time. So let's look at the limits. Okay. IRA contribution limit. This is for 2025. $7,000 is the most you can put into an IRA. By the way, you have to have earned income unless it's a spouse. You can actually make a similar contribution for your spouse. Okay. Now, your eligibility for a deduction, a tax deduction on that IRA contribution depends on a couple of factors, whether or not you're covered by a qualified plan through your employment and what your income is. So it's possible that you may not qualify for a tax deduction in your when you make your traditional IRA contribution, but everybody, as long as they have earned income, at least the amount of the contribution can make a contribution to a traditional IRA. Okay. Whether or not it's tax deductible depends on a couple of factors, right? To make a Roth contribution, it doesn't say it here, but that phase out range for an individual starts at 150,000 and ends at 165. So if you make more than 165,000, as a single individual, you cannot make a contribution to a directly to a Roth IRA. Right. Married filing jointly, that threshold goes up to 246,000. So in between 150 and 165, you can make a partial contribution to a Roth, or in the case of a traditional, and you're eligible for a. I'm sorry, this is strictly for Roth. I apologize. This is strictly for Roth. So if you're in between the 150 and the 165 for a single individual, 236 and 246 for a joint filer, there's a partial contribution available. So if you're at 241, for example, you could put up to $3,500 directly into a Roth. Get that?
I get that.
Does that make sense? Okay.
I think so. I'm absorbing it, but yes.
And again, anyone above those limits can still make a non-deductible contribution to a traditional IRA and then convert it to a Roth IRA. This is the backdoor Roth strategy. Mm-hmm. So even though you can't make it direct because you exceed those thresholds, you can still do an indirect by making a contribution to the Roth IRA. So executing a backdoor Roth IRA several steps. First, you open a traditional IRA account if you don't already have one. Next, make a non-deductible contribution using after-tax dollars.
Mm-hmm.
For 2025, the maximum contribution, as mentioned before, $7,000 or $8,000 if you're 50 or older.
Right.
After funding the traditional IRA, you convert that contribution to a Roth IRA. Ideally, this conversion should occur soon after the contribution to the traditional IRA. Why? To minimize taxable gains. Because if there's any gains that happen between the contribution that you make and the conversion, because you're investing that money, right? You're putting that money into an account, you're investing it. If it makes any money in between the time that you make the contribution and you make the conversion,
That will be taxed.
you will have to pay taxes as ordinary income.
Okay.
And it is critical that you file IRS Form 8606 so that you can report the non-deductible contribution and the conversion. And also be aware of the 5-year rule, which requires converted funds to remain in the Roth IRA for at least 5 years before penalty-free withdrawals begin. So it doesn't matter when you set up the account, it matters when you make the conversion.
Right.
So even though you may have set up a Roth IRA account 5 years ago, and now you've met the holding period for qualified distributions, if you put converted funds into that Roth IRA, those funds have to stay in there for at least 5 years before you can pull them out.
Oh.
Otherwise, they potentially can. You'll have to pay taxes on the amount that you converted or the amount that you pulled out. So it's no longer
Each time on each rollover?
on each rollover has a separate 5-year holding period. Yes, that is correct. Yep. And so it's and there could be there's an excise tax paid as well, right? So you pay taxes on it, plus you pay an excise tax, even if you're over age 59 and a half, by the way.
Mm-hmm.
So the 59 and a half is not, it doesn't exonerate you from having to pay a penalty if you're pulling the funds out within 5 years of conversion. Got that?
Yeah.
So
Jeez.
timing and accurate documentation are critical to avoid unnecessary taxes and penalties. Let's take a closer look, right? So here's some of the common mistakes that people make. One of the most significant challenges in executing a backdoor Roth IRA is the IRS pro rata rule. This rule applies if you have other pre-tax IRA balances, such as traditional, SEP, simple IRAs. When you convert funds to a Roth IRA, the IRS considers all IRA assets combined, meaning that only a proportionate share of the conversion will be tax-free. For example, you contribute $7,000 after tax to a traditional IRA, but also have $100,000 in pre-tax IRA funds. Only about 6.5% of your conversion, that's $7,000 if you convert it, is going to be tax-free. And the remaining 93.5% will be taxed as ordinary income. Okay? So, in other words, you cannot make a backdoor Roth IRA. You cannot intend to make a traditional IRA contribution on an after-tax basis, convert that account to a Roth in a vacuum.
Right.
You have to consider all of your IRA assets. So common mistakes include the pro rata rule, delaying conversion and incurring taxable gains,
Right.
failing to file the Form 8606, and then misunderstanding the 5-year rule for converted funds. These errors can lead to unexpected tax liabilities and penalties. So careful planning and professional guidance are recommended. And by the way, so you might think that, hey, I've got all this money in IRAs that are all pre-tax, and it doesn't seem to make sense that for me to do a backdoor Roth at this point in time. I do have a solution for that,
Okay.
but you're gonna have to call me for that.
Uh-oh.
For that one. That one you're gonna have to call me for.
That sounds
But I do have a solution for you for
okay,
that.
great.
For that one.
877-475-2062.
Yes. Yeah. I say call. You can send me an email. We can chat. But that's going to be a one-on-one discussion.
Okay.
Because there is a way to get around it. If you really are intent on making Roth contributions and your income exceeds those thresholds, and you want to use the backdoor strategy.
I may have to call. I'm curious.
So, why would you consider a backdoor Roth? Because it offers several compelling benefits. Once funds are in a Roth IRA, they grow tax-free. Qualified withdrawals in retirement, also tax-free, providing significant long-term savings. Roth IRAs, again, do not require minimum distributions. I think this is the one that's the most important of all. Well, tax-free withdrawals, I guess that's good, but I mean, you can argue whether or not, and I do this all the time for clients and for my own edification. We constantly comparing the decision to make a pre-tax contribution, get the tax savings now, or get the tax-free withdrawals in the future, pay taxes on the money. Basically, if you're not making a pre-tax contribution, you're paying taxes on the contribution, so you have less to invest, right? If you do a pre-tax contribution, you have more to invest. And so when you compare the tax benefits of both over time, this is what I've learned. If you're in the same tax bracket when you put the money in as when you take the money out,
yep,
and you earn the same rate of return on those assets during the time period that you have it before you start making distributions, it's a 6 of one, half a dozen of the other. It's the same. There really is no difference. It might actually be a preference or maybe a psychological benefit of saying that, oh, I'm going to pull money out tax free.
Yeah.
But when you consider
financially, it's no different.
When you consider the fact that you're getting the tax right, when you consider you get the tax benefit earlier rather than later, and you have more money to invest, you can argue that the pre-tax is a better idea. Now, if you're in a lower tax bracket when you retire, pre-tax contribution is probably better. If you're going to be in a higher tax bracket when you retire, then the after-tax contribution into a Roth is probably a better idea. So there really is there isn't one that's better than the other. It really depends on your individual circumstances, right? What else? Other benefits.
Estate planning benefits.
Well, I think the estate planning benefit primarily is, and this is key, and a lot of our clients are concerned about this. It's very possible that your kids could be in a much higher tax bracket, right? And when they inherit that asset, if it's a traditional IRA, all taxable money coming out, that could hurt. But if you give them a Roth IRA as an inheritance, they're going to thank you.
Yeah.
Posthumously, they're going to thank you.
Yeah.
Other benefits, converting funds to a Roth IRA can diversify. Oh yeah, here's one. So we said, what's the best way to do it? Is pre-tax or after tax into a Roth? Is that one better? A lot of times what I advise my clients is do both, right? Do both, right? And so then when you're in retirement, you have a choice. So whether or not you're going to take money out of the traditional IRA, depending on what your tax situation is that particular year, or you're going to use the Roth. So it gives you diversification in terms of taxable income. And of course, for higher earnings who expect to remain in a higher tax bracket, this strategy can lock in tax-free growth and withdrawals, and actually can benefit you in terms of other income thresholds. For like the additional Medicare tax is based on your adjusted gross income. If you're pulling money out of Roth IRAs, at least for now, it's not adding to your it's not adding to your adjusted gross income. So you could potentially avoid paying the additional Medicare tax. Be careful though. Be very careful, because contribution limits for IRAs are set to increase slightly in 2026, with the standard limit rising to $7,500. Catch-up contribution for those over 50 is going up to $1,100, Lou. It's been $1,000 forever, and they're finally going to increase it to $1,100. Isn't that nice? And the regular limit going up $500. It has not changed in quite a while, so that's a good thing, right? However, there is ongoing discussion about potential legislation. What's the likelihood they're going to pass anything in the in the next Congress? But be aware, there's ongoing discussion about legislation that could eliminate or restrict the backdoor Roth IRA strategy starting when 2026, making 2025 potentially the last year to take full advantage of this approach.
So something you need to explore.
Yeah, I mean, I don't know for sure what's going to happen. If you ask me what the chances are, given the current status of the Congress, it's unlikely they're going to get a lot of stuff passed. They've got some items on the agenda that they have to address more immediately.
Going to be shut down for the rest of 2025, probably.
But they can make it. Lou, they can make it retroactive.
That's true. Yeah,
they can make it retroactive. But apparently, it's on somebody's radar. This backdoor Roth. They're probably thinking, "Wow, this is only for the rich."
Yeah.
So we got to do something to stop them from not
rich.
paying taxes.
Yeah. I hate the rich.
Be aware that 2025 might be the last year you can do the Roth. And here's the good news: you can make this happen right up until April 15th of next year. So any contribution you make to a traditional IRA can be made up until April 15th, but not beyond. So you could actually do your traditional contribution, after-tax contribution, and then do the conversion right away. You don't have to wait. You can do the conversion right away, and that would allow you to take advantage of the 2025 rules that are still in place. But be aware that they could change. Best practices include converting contributions soon after funding the traditional IRA to minimize capital gains, rolling pre-tax IRA balances into an employer-sponsored 401k to avoid the pro rata rule, maintaining accurate records, and consulting with a CPA or financial advisor, obviously, for complex solutions. Staying informed about legislative changes and IRS rules is essential to maximize those benefits. So that's our explanation of the backdoor Roth. So we're going to take a break.
Yeah, they said it's a good time to look into it, right?
Yeah, yeah. And if you need some help and you want some ideas on how to maximize this and avoid the pro rata rule, give me a call. 877-475-2062. Send me an email, jeff@talkmoneyradio.com. But stay tuned. We've got the Ask Jeff question of the week coming up.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005.
I'm Jeffrey Shank, and this is the Ask Jeff question. Hey, so Lou, I had this question come up, and it's kind of, it's funny because I was talking to somebody about this just yesterday, and it was just in the last few years that I learned about this, and I was actually kind of shocked. But my company 401k plan has a provision that allows me to contribute more than the IRS limit. That's this year, I think 23,500, 7,500 if you're 50 or older. So it allows you to put more than that into an after-tax account with a very high upper limit. I don't get the immediate tax benefit, so it's an after-tax contribution, but the earnings are tax deferred. I'm told in my case, I can put in another $23,000 every year. Is this a good idea? So
the company's just skirting the IRS rules?
No. It is it's a provision. It's not in every 401k plan, but the IRS has, when we talk about these limits, these contribution limits, they're mostly the voluntary contribution that you can make into a 401k, but the IRS actually allows the company to put even more money. And so you can elect to defer even more money, and it's considered an employer contribution because you're saying to the employer, I don't want it, put it into this plan, right?
Okay.
But it is an after-tax, in this particular case, it's an after-tax contribution.
Right.
And so I'd say that first of all, you really have to look at your 401k plan to see if this is available. But in this particular case, this person knows that this is available. And I'd say that you want to save as much money as you possibly can for retirement. And if you can afford it, I'd say take full advantage of it, because it has another benefit. And that other benefit is that when you retire, when you leave your employer, any money that you have in after-tax accounts can actually be rolled over into a Roth IRA account.
Okay.
A Roth individual IRA account.
Yep.
And so think about that.
Yeah.
Because we were talking earlier about the backdoor Roth IRA.
Right.
They actually call this the mega backdoor Roth.
Wow.
Yes, the mega backdoor
Big,
Roth.
beautiful backdoor.
They actually that actually is has a name, and it's the mega backdoor Roth. And so that would be I ask every actually it was funny because I was sitting with some colleagues we meet on a regular basis, and hey, what'd you learn? What happened? What's going on in your neck of the woods? And I said, hey, you guys ever heard about this mega backdoor Roth? No. I mean, it was like,
wow.
Yeah. It was nobody had heard of it. And so, and it's because it's unique and only certain plans offer it. But now I ask everybody whether or not they have this provision in their 401k, because anything you can do to build up your retirement assets, and anything that you can do to minimize the taxes on those, right, on the growth and the distributions in the future. And again, being able to have a source of tax-free income gives you some flexibility and the ability to use some of that money to pay for your basic expenses, but also at the same time not increasing your tax bracket or putting you in a situation where maybe you're going to be subject to that additional Medicare tax, because there is, once you are covered under Medicare, you pay a Part B premium. Everybody pays the same unless your income goes up above a certain level, and it can be a pretty hefty increase in the premium. So by having these sources of income that you don't have to pay taxes on can be very helpful in retirement. So in this particular case, I think it's a good idea. And if you can afford it, that would be the key. If you can afford it, keep in mind that, once you put the money in there, it might be difficult to get it out if you needed an emergency, because the qualified plans have certain restrictions on withdrawals while you're
Right.
still working with the company until you reach a certain age. So be careful. If you don't need the money, you can afford it, and it definitely would make sense. And why not max it out, right?
Yep.
Max it out.
Max it out. Yeah. If you can legitimately afford it, don't put yourself in a bad situation.
Right. Exactly. Yeah. And so that's this week's Ask Jeff question. We'll be back next week with another Ask Jeff segment. In the meantime, please remember, good sound advice is much better than advice that just sounds good.